Welcome to the Value Investor TV podcast. This is the podcast, your favorite value investor podcast. I tried a new line there.
And it didn't work. It didn't work at all. But that's okay. We're just going to keep going.
Okay, keep going. Let's move forward. My name is Becco and my partner, Hari.
How's it going?
Great to have you guys here. In this episode, we will continue our discussion on Five Below. It's a company that was suggested to us by one of our listeners, who is also quite active in the Slack community. So if you guys want to get involved in the Slack channel, please email us and we can get you invited to the community, get you plugged in here. Also, we are going through valuation checklists like we do for every company. And if you'd like to get a hold of this checklist, please also email us at info@valueinvestor.org. All right. Let's get right to it, Hari. Oh, actually, before that, I forgot about the disclaimer. So could you give us a quick disclaimer before we get started?
Yeah, this is the Value Investor TV podcast. We are the podcast that helps you understand the concepts behind value investing. We are for educational purposes only. Every company that we talk about here is, to educate you. We are not financial advisors. We don't know your specific financial situation, so please consult with the appropriate advisor before making any financial decisions.
Okay, great. Let's get right to the question. The first question is the company able to translate its moat into high returns on capital? So this question is really relevant based on the previous questions that we asked, which are really discussing in detail about the competitive advantage, thinking about the capital reinvestment requirements and things like that. So if you guys haven't listened to the first episode, please do before you listen to this one. All right, let's get to this question. Is the company able to translate its moat into high returns on capital? All right.
Yeah, so the important thing that we, when we always talk about profitability is looking at a company with the eye on how much money does it generate. So if I have a business that generates 15 cents for every dollar of revenue, right? Or 15 cents for every dollar of equity that I have in the business. Well, a business that generates 30 cents for every dollar is better, right? So, you're looking at a company like Five Below, they have a pretty good return on equity of 23%, which is very admirable for a business, right? Which is why this company reminded me a lot of Tractor Supply. Like Tractor Supply is not selling anything super crazy, but has a very high return on capital of around 25%. So those kind of businesses do very well. And when you look at it another way, which is their investment for starting a store, as we talked about, was $300K for the first year, and it generates about $1.8 million in revenue. So when you look at it, their net profit margin is around 9%. So for every dollar that they spend, they get about 9 cents goes to the bottom line. From dollar for revenue becomes 9 cents in profit. So that kind of translates pretty well for, $1.8 million in sales, gets you around, $160,000, $170,000 in profit for the year, right? So on a $300,000 investment in about 2 years, less than 2 years, they're going to pay off that investment, right? That's a pretty good deal. But that is based on, and you would think, okay, with the high rate of return on capital, there is some moat to this business that protects them from, competitors, right? They're able to do something and generate a generous profit off of it. When you compare that to Costco or Walmart, their profit margins are much lower, 2 or 3%, right? So clearly Five Below is making money here that is doing well for them. So I think the answer here is yes, they have a high return on capital. I am curious about the defensibility of the moat. And maybe I'm being too harsh on them for, if they're able to generate profitability like that, then, there's clearly a moat here that I'm having trouble defining, as strong. So.
Yeah. Okay, let's go into the next section of the checklist, which is the financials. Does the company have enough cash to maintain its business?
Yeah, so that's an interesting question. I did not really look closely at how we're now in the COVID era, which has a different kind of worldview, really, for a lot of businesses. So up until a year ago, they didn't have any debt. They took on about $900 million to expand distribution centers and do other growth capital initiatives. And I don't see that debt being a real problem for them. I think their business will rebound and it'll be coming back. But they have around $200 million in cash. I don't know if they're still paying their workers or if they have how much e-commerce is going to be able to sustain them for the next couple of months. But I think they'll be okay, going forward in a systemic shock environment.
Mm-hmm. But also, since they just took on the debt, I imagine it's not going to be due for a while. So at least in the short term, in terms of the risk of bankruptcy, for example, things like that, it sounds pretty minimal at this point.
Yeah, and I will say that I was able to read the 2018 fiscal year 10K. The 2019 fiscal year 10K came out in between the time that I read and the recording of this podcast. So I only updated some of the items like the store count and the latest financials, but I didn't dig too deep into the debt maturity. So I'm not concerned, to be honest with you. I'm just more interested to see, I think this company has enough resiliency that they're not going to, unless there's a super long, prolonged shutdown of the economy, I don't see it being a problem.
Yeah. Do you have numbers specifically around the percentage of revenue coming from online business? E-commerce?
No.
Okay. One thing that is interesting to always look at for retail business from what I've seen, like for example, Canada Goose or Ulta, for example, or Skechers even, is that everyone is going to a direct-to-consumer model and becoming omni-channel. And when you see these numbers come out and they tout that, 50% growth, 60% growth year over year, but you're starting with a very small baseline. So going from 1 million to 2 million, even though it's 100% growth, it's small nonetheless. So I would, this is just a general comment, not specific to Five Below. I would just caution that, from taking that at face value.
Yeah, and I think the interesting thing to me is Five Below's strength is not being an e-commerce store, right? It's being able to walk in, buy a bunch of stuff that you wouldn't otherwise buy, that e-commerce sales doesn't really benefit you, right? Like, you're not going in and seeing 5 other things that you end up picking up if, and doing these impulse purchases when you buy stuff online. I mean, that's typically people's kind of behavior pattern. So I will say that I like the, you kind of almost have to have an e-commerce business in this day and age, to be competitive and to weather the storm. But I don't know that it's a competitive advantage for them. I think it's actually a detriment for them in some ways.
That's a great point. Okay, I think we touched on this. Maintain reasonable level of debt. We talked about that. Let's talk about the third question within the financials, which is, can the company generate a strong amount of free cash flow from operations?
Yeah, so they generated $175 million in net income, and their actual cash property, plant, and equipment, or net property, plant, and equipment was greater than their net income. But when you actually break it down, you can see that a lot of that was due to a distribution center that they're building out. So a heavy capital outlay up front in order to do that. And then there was, so what I kind of whittled down their maintenance capex to was around $60 million. And I didn't pick that number because that was something that I read straight out of the cash flow statement, but I did some math and essentially figured out, they're opening about 150 stores at $300,000 a pop. And so whittle down how much of that was distribution center, which they did say, and how much of that was new stores, and then the remainder is what I consider maintenance. So
I see.
A lot of people will say, if you don't know what it is, then just use the whole amount. Well, then their valuation would be basically zero, right? Because they would have no cash flow. So I had to do some, and I think I wasn't being overly, I was being relatively conservative, I would say, with it. So
in terms of the CapEx, for the past few years on distribution channels or distribution centers, how do you think about that and reconcile that with what you said about e-commerce as a strategy for this company?
Yeah, I mean, I don't know if
I
don't know where the distribution centers play into the e-commerce part of it. This is mostly to funnel stuff to their stores, and I want to say that their distribution centers are in places like Mississippi, Georgia, and New Jersey. I may be wrong on those. I know the new one is in Georgia, but the geographic distribution of these is more in the east, and so I wonder in the future if they're going to need to open them up, to put them in the Midwest, to and the West when they start expanding into the Western markets. So, but I don't pay attention a lot to that stuff. I don't know that it's not a competitive strength. It's not a competitive disadvantage. It's a distribution center, and that's all I think about, with
Sure.
it.
It's also something that, for me at least, I just immediately went onto distribution centers equals e-commerce, but certainly not the case.
Yep.
Yeah. Okay, let's move on to next set of questions, which is all about management. And you said before we started this podcast that there wasn't anything particularly outstanding about management in terms of any issues, management issues. But you also said that they touted their management background and their track record as one of the competitive advantages for the company. So if you could spend some time talking about the management here. All right.
Yeah, so they cite their CEO that had a background in retail for the last 20, 25 years. It's one of those things where I'm just kind of like, I don't know how much of that is really all that beneficial and how much of that is just your trying to put a good spin on it, right? Like in some ways the executive here management team doesn't really matter all that much, right? In other ways it matters. Their merchandising person, I would say, has a bigger impact on this store than the chief executive, right? And I know that's sacrilege to a lot of people because, he's the CEO. That's the biggest, there are a lot of businesses that the CEO is just there to run the ship, right? It's basically just to make executive decisions. And when you look at it, the incentivization structure that they have is around operating income. About 75% of the CEO's pay is based on operating or his bonus, and the other 25% is based on revenue. And so, it's conceivable, right? I mean, this is a good thing, I would say, that they're focusing on operating income. And then some of their merchandising officers are based on inventory turnover. So they want them to, high turnover leads to more sales lead to better cash conversion and, that kind of stuff. So what do I think of all of that? I don't have any strong sense that they're, doing a bad job. Obviously, a high return on capital is a great thing. I'm also not entirely sure that the management is the sole reason that is the case, right? Sometimes, the business itself is so good that even an idiot can run it, right? And as Warren Buffett says, you would want a business that an idiot can run, because one day an idiot will run it, right? And so I don't know that they're necessarily like the competitive advantage for this company is their executive team, but just as a something to think about, I don't see this as, there's no red flags here. There's also, they're doing the things that I would expect a retail store to have, heavy operating income and some revenue, right? That's kind of the normal incentive structure.
Great. Anything else you want to talk about in terms of management before we move on to valuation?
So not really. I mean, they don't have a heavy buyback program. It's pretty small. There's no dividends, and they've said that they don't plan on paying dividends. I would expect a growth company to not do that, right? They want to be growing, so they want to be putting all of their money back into the business. As far as taking on the debt, I'm not entirely sure that was necessary. I think there's a lot of, focus here. If you think about it from the incentive structure, right? If I'm incentivizing you, Becco, I'm the chairman of the board, and I set your compensation based on, net income, operating income, right? And revenue. Well, then if you load up on debt so that you can buy, expand the business very quickly, well, then you could increase revenue and you could increase operating income, right? But what you may not be doing is increasing net income, because the interest and taxes occur after operating income, right? So your focus may not be on unlevered, growth of the capital, right? Of income. So I'm always like, when I look at their free cash flow, it's still lower than the 3 times free cash flow number that I'm comfortable with, right? They're at $950 million. Free cash flow is kind of, around 120, 130. It's not great. So, I'm not thrilled with it, right? I would like to see more free cash flow in a business like this. And I understand, as a growth business, you're going to see a lot less than you expect. And you're looking at, a revenue base that's been growing at 20% and an equity base that's been growing at 20%. So that's kind of where, all of the money is being funneled to. And it may just look more anemic than it actually is, right? Like if they stopped the growth initiative, that free cash flow number would balloon. So.
Yeah, absolutely. Okay, let's move on to the valuation. So the question is there a margin of safety? All these questions we'll talk about that after you kind of walk us through your valuation assumptions and your analysis.
Yeah, so my initial cash flow that I picked off with was $120 million. So I said that they had $175 million in net income. I took out around $55 million as maintenance CapEx, and I assumed that they had a growth rate of 20% for the first 5 years and 10% for the next 5 after that. They've been growing around 22%, 23%. For a good while. So that number is a little bit, I think it's sustainable. It's not necessarily conservative, but I think it is sustainable. I could even hear an argument for 22, 23%, but I picked 20. My discount rate is always 10%, and I set a margin of safety of 50%. So that is kind of my base case, right? My conservative case. And I came up with an intrinsic value of $67, $68, and margin of safety price of $34. They're trading in the 80s right now. So, I think they're too expensive. I think it is conceivable that you could use a higher number for their
growth rate,
and a higher number for their cash flow. So I'm just going to assume that their net income is actually their cash flow. And I can get a margin of safety price of $50 with the same growth rate. So, it's obviously you can easily lull yourself into thinking, oh, well, if I just play with this and I play with that, I'll get a better, I don't think that's unreasonable to say that it's hard to measure what their actual cash flow is because of, you're pulling money into expanding your stores, you're pulling money into this distribution center, you're pulling money into other places. So it all depends on your assumptions, right? And I think if this price, if you came to me and said, this is company's $50 a share, they've got a great growth rate, they've got a great return on capital, I would be comfortable with saying, yeah, $50 a share is reasonable, right? But it's hard for me to justify it with in the $80 price range, right? There's just not enough margin of safety there for me to make it a reasonable price.
Yeah, and also I think maybe we have to also always think about valuation in terms of the risk, but also in terms of the competitive advantage, right? So we talked about in the first episode, if there was a sustainable competitive advantage that you would kind of, have that in mind when you go into the valuation, perhaps you could hear an argument for buying a company that is expensive above the intrinsic value that you came up with, right? If there was a moat that was impenetrable, for example.
Right.
But, this is something that we, at least you and I, couldn't really articulate the competitive advantage, sustainable competitive advantage here. And therefore, when we go into valuation, we need to take that into account when we think about what is the intrinsic value and what is the price point at which we'd be comfortable purchasing this.
Yeah, and what I would say is in Q2 is going to look really ugly for them, right? It's going to be a huge negative number. And I'd be curious to see, what does Wall Street do with it, right? Do they just shrug it off and say, oh, it's a one-time thing? Does it dip? And, I would pay attention because I think there is potentially a buying opportunity here. But, it's like Benjamin Graham always said, the margin of the Mr. Market all is just a quoting machine, right? They're going to give you a price and you can ask a price every day and it's your decision whether to do something about it or do nothing, right? And as value investors, 99.99999% of the time, we're doing nothing, right? We're just going to look at the price and say it's too expensive. And so when you find a business like this, I think there's definitely a price point at which I would say this is a great business to own for a long period of time. I just don't think it is right now. And if you're lucky enough to get it under the $50 share price point, I would say it's very well worth looking into. But at $80 a share, I don't think it is. So,
I'm actually a little surprised that you said that it's a company that is worth owning for a long time.
I think there is, obviously you would need to look at that return on capital over time, right? And I am worried about their capital allocation that they've done with the debt, right? I think too many businesses are going after cheap debt right now, and that is going to hurt them, right? And especially now that they're going to have to load up on additional debt just to maintain payroll and maintain other things until the economy improves. This company is not at risk right now, right? I don't think that that's going to be a problem. But if they continue to load up on more debt, I would be concerned, right? But a high return on capital is a thing, right? It is an important concept. They are able to, do a pretty good job with the money that they have. If they invest this money wisely and they expand their store base wisely, and I would much rather that they have been conservative with that capital instead of using $900 million in debt. If they just expanded organic, from cash flow. But this is how companies operate in this day and age. So, we can always pass, right? We don't have to look at it.
Sure.
So I think that the real thing here is, what is it going to look like in Q2 of 2020? And that's going to tell us a lot about this business.
Yeah, return on capital and the debt question, the competitive advantage question. Yeah, as we discussed in the first episode, we kind of came to the conclusion that brand is definitely there, competitive advantage wise. Numerically, we talked about return on capital, and it was pretty impressive. But qualitatively, discussing through various types of competitive advantage, brand, network effects, switching costs, low cost, intangible assets, we're able to articulate some things around brand. So if you guys have ideas about why this business is able to generate that 21%, you said 21%?
23 almost.
23% that we didn't touch on, we couldn't articulate, please do so. Email us, leave us comments, things like that. All right. Anything else you want to mention in terms of valuation before we close out this episode, Hari?
No, I mean, I picked a growth rate of 20%. It is obviously not going to be 20% this year. So, that I'm pretending in a lot of ways that this year doesn't matter, for their long-term prospects. And I may be wrong on that too. So, I think we're all, the problem with a business like this is that they're a non-essential, kind of entity. And so it's going to be hard to really judge. So, the answer can also be no, right? And just move on and look at other businesses. And right now that's where I'm at, right? I like the business. I'm going to put it on a watch list, but I'm not going to be, I need to have a good margin of safety, and I don't have it right now. So.
Great. Awesome. Thank you. Thank you for going through that. And thank you for suggesting us this company to look into for this episode and the previous episode. If you guys have a company that you guys have in mind, always email us at info@valueinvestor.org. We'll try to get to them as soon as possible. And as we mentioned earlier on, Slack channel is available for us and for you guys. If you guys would like to talk to us directly or exchange ideas and information amongst the group, you're welcome to join our Slack community by emailing us at info@valueinvestor.org. And also the checklist, if you guys want a copy of this checklist, please email us at info@valueinvestor.org as well. All right, guys, thank you so much for listening and tuning in. I hope you guys stay safe, and hope to see you guys in the next episode. Thanks, guys.
Thanks.